Very good morning to you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in this today's VCM on clause by clause discussion on CARO 2020. The topic is very relevant in these days. So AASB has already conducted various VCMs on various standards on auditing. Now we have already conducted one VCM on CARO and Schedule 3. Now we have divided this CARO 2020 into 21 clauses. There are 21 clauses. So we have subdivided these 21 clauses into three parts. Today we are covering 6 clauses. In the next VCM we will cover 5 clauses, and in the third VCM we will cover 10 clauses. So we are fortunate enough, we are having with us our Honorable Central Council Member, CA Rajendra Kumar PG, the Honorable Chairman of GST and Indirect Tax Committee of ICI and Management Committee of ICI. We are having with us both the learned speaker, CA Nilesh Kemka ji and CA Parveen Kumar ji. So on behalf of AASB of ICI, I extend my warm welcome to both the speakers and Honorable Central Council Member. Welcome to you, sir.
Thank you, sir.
I also welcome all the members. I also welcome all the members who have joined for today's VCM. Members, we are going to cover 6 clauses for this CARO 2020. First one is PPE, inventory, statutory audit, non-cash transaction, resignation of statutory auditor, and corporate social responsibility reporting requirements relating to the unspent amount. So both the technical sessions will be taken care by both the learned speakers. Before that, we have with us our own Central Council member, Honorable Chairman of GST and Indirect Tax Committee with us. So may I request Honorable Chairman, sir, to please deliberate your keynote address, sir. Over to CA Rajendra Kumar PG, Honorable Chairman of GST and Indirect Tax Committee. Over to you, sir.
Thank you, Anil. And thank you to your chairman and your vice chairman for giving me this opportunity to be on your forum, in spite of the fact that I am very, very far away from the subject that you handle or you deal with. But as you say, the judge need not know the law, he has to be told the law. I'm not sitting here as a judge, but then to be seated with Parveen Kumarji, who is a personality in himself, I must say. A person who has carved a niche in the profession, and the very young Nilesh Kemka, it gives an added honor for me to be here. In fact, a long time back, must be some 20 years before, I had come face to face with Companies Act, the provisions and so on. And today, after so many years, when I look at the Act, when I look at CARO, when I look at what you have told just now, it looks like I'm totally out of context in the subject. Nevertheless, for people like me, the institute's because it is a picture of learning, it also exposes the person to the areas which hitherto have not been his forte. In fact, so many changes have come in the last few years, maybe last about 6-8 years or so, in the Companies Act and the requirements with respect to CARO, etc. And in my 5 years of disciplinary committee stint, first year I was there in 2010-13 when I was a Central Council member then. And then when I got re-elected in the last term, for the last 4 years, I have been on disciplinary bench too, handling the cases of in the filed by various bodies. And when I look at the cases which have been filed, many of the cases pertain to non-reporting. Many of the cases pertain to not following the requirements laid down by the Companies Act, the requirements of CARO not properly fulfilling the report given by the statutory auditor and so on. In fact, for these reasons also we have to hold the member guilty. See, at the end of the day, the punishment may be only a reprimand, but then holding a member guilty and reprimanding in itself is a harsh punishment for a professional of a repute professional of high standing. So these kind of programs which the institute holds and bringing in towering personalities. I don't know from where Parveen Kumarji gets the time to come to institute's forum, sit here, spend 2-3 hours. His 2-3 hours itself is worth a few lakhs of rupees, I must say. And young people like Nilesh Kemka under Parveen Kumarji will certainly not only teach us, but will also he himself will learn about various aspects. And members are fortunate that our Auditing Assurance Standards Board is doing such a great job for the members, for the community, and for the nation as a whole. You hold the key. If this particular area is properly looked into, I must tell you, members, the cases in the DC will decrease, and decrease, and it will only hope so that we perform our duties to the best of our abilities and ensure that we live up to the expectations laid down by the legislator from time to time. So best wishes to all of you, and sincere thanks to Parveen Kumarji and Nilesh ji for honoring the institute time and again whenever we require them. And thank you, Anil Lal, for this wonderful opportunity given to me. And esteemed members, they must be thanked for being with us here. And of course, it is their own interest also is served here. But then they're spending their valuable time on a working day. Thank you very much. Over to you, Anil ji.
Thank you so much, sir. Thank you so much, sir, for your keynote address and words of wisdom. Thank you so much for sparing your valuable time. So if you permit, we can start the technical session 1. Sir. So moving on towards the first technical session, that is the part 1 of today's VCM. We are having with us our first speaker, CA Nilesh Kemka ji, Parveen Kumar ji, and second speaker, CA Nilesh Kemka ji. So it is my proud privilege to share with you the brief profile of both the eminent speakers. CA Parveen Kumar ji is a senior partner and national head of assurance division of ASA, and the organization has 8 offices and 700 plus team members. CA, with 30 years of post-qualification experience, a commerce graduate, holds diploma in information system audit besides certification in IFRS from UK. He has been a member of NACAS, Accounting Standard Board, AASB, and Expert Advisory Committee besides various research group committees of Indian Institute of Chartered Accountants of India. His experience of working on large number of risk advisory assignments, audits, forensic fraud investigation, and IFRS transition for the various corporates. He's a speaker at national and international forums on a subject of expertise. He's a faculty with reputed institutes like IMT, NAAA, ICAI, ICSI, ICWI, CAG, NIFM, MCA, IICU, Delhi University, etc. He has written a book on consolidation under IFRS, conversed with Indian standards besides paper and articles, which published in various renowned journals and magazines. He is invited as a present paper by reputed institutions in Japan, Nepal, Myanmar, Dubai, Singapore, besides various large companies and branches of Institute of Chartered Accountants of India across country. His personal hobbies include marathon and running also. So once again, welcome you, Parveen Kumar ji. Thank you so much for sparing your valuable time. May I request you to please start your deliberation with your expertise, sir. Over to Parveen Kumar, sir, please.
Thank you so much, Anil ji. And I'm really grateful for your kind words, Rajinder ji. It's been always very lively interacting with you, and I really enjoy your company. And I'm really thankful to you for all the contribution which you are doing for our members. So and handling one of the most difficult committee at this point of time, when there are agitations going on and there are all kind of disturbances in our profession going on. So you are at the helm and representing us. So thank you so much for all your effort and selfless efforts for all your contribution to the profession, sir.
Thank you, sir. Thank you very much.
It's a privilege and an honor to share the dais with you. So this topic of today, you very rightly said, sir. Lot of people, lot of regulators are looking at these reports very, very closely, and they are looking at the reporting done by the statutory auditor from a very close scrutiny is being done. So we need to be careful, and it's really appreciable that AASB has again picked up CARO. And this time they are going clause by clause, and they are, having these sessions for the members. So whenever we are, going to the client location or going to the branch or going to meet with our fellow colleagues, I think first topic of discussion is what is to be reported, how it is to be reported, clause 9, ratios, various issues which are being discussed and debated. The institute has also taken initiative to revise the guidance note, and there are various study groups which are working simultaneously on war footing, and that guidance note is in the process, and very soon it will be out. For today's discussion, I will be sharing, those three areas. So basically, we start from 3.1, and this is how it is done. But Mr. Anil felt that internal audit is also very critical points that need to be shared immediately in the first go itself. So I'll be sharing those clauses and some of the critical requirements which are there. So the idea is that should be aware of what exactly is required by the law, how the auditor can carry out their audit procedures to meet the responsibility, to meet the requirement of this reporting, and most importantly, the kind of documents the auditor should maintain in the audit work paper file. So, as a protocol, a disclaimer: whatever I'm going to share with all of you is my personal thoughts. They are not thoughts of the institute. They are not opinion of the institute. These are not the formal opinion or the formal kind of statement from the institute. As a faculty, we share our thoughts, and we also share the issues where we are still debating. So these are all my personal thoughts, which I'll be sharing with all of you. So, if Anilji, if you allow, I'll be sharing my.
Yes, sir. Kindly, sir. Kindly, sir.
Sure. Give me a second, please. Is the presentation visible to all of you?
Yes, sir. Yes, sir. Fine, sir.
All right.
Make it full screen, sir. Press 5. Make it full screen. Yes. ठीक है, sir. Thank you.
Is it visible? Okay.
Yes, sir. Yes, sir. Fine, sir.
Okay. So, friends, because it is a first session, so I will spend couple of minutes or couple of slides on, the CARO, the new CARO which is there, the key clauses and key changes which have happened. We had been reporting under CARO in the past also, and with this new CARO and this new Schedule 3 coming into play, there are a lot of interesting changes which have taken, which are going to be reported. So I'll be sharing some background, and then I'll go to these clauses which have been given to me. So I will take approximately half an hour for this, and after that we will have some time for Q&A. So in case you have any question, you can either send it to Mr. Anil, who is the coordinator, or you can put it in your chat box, or so we can try to address those questions. So basically, the central government is given power under Section 143(11) of the Companies Act 2013. Under these powers, the central government has issued this order, and every auditor who is doing the statutory audit will need to report on the requirement of this CARO. There are certain exceptions which I will be sharing with you in the next slide. But let's read the Section 143(11). The central government may, in consultation with NAFRA, by general or special order, the central government may direct in respect of such class or description of companies as may be specified in the order, that the auditor's report should also include a statement on such matters as may be specified therein. So very straightforward, the power has been given to the central government, but They will be consulting with NAFRA, National Financial Reporting Authority. So this particular CARO 2020 was initially applicable for the statutory audits of the financial statement for the period beginning on or after 2019 April. But later on, there was some, some resistance, and the notification came, and it had become applicable from April 1, 2021. So any financial statement which is, the period of those financial statement is beginning from April 1, 2021 or later. So this particular order will be applied. So many times the people, they ask question that in case there is a financial year is the calendar year of the company. So from January to December or some other year, then you have to keep in mind that this is applicable for the statements which are period beginning on or after April 1, 21. So March 22, is the year ending. So any financial statement which are prepared for the, year ending March 22, so this statement will be applicable. So you will have to apply the new CARO in, financial statement. So generally, April to March is the financial year. This March 22 balance sheets which you are going to audit or which you have already done, this CARO will be applicable. So the applicability of this CARO was similar to the previous CARO, which was CARO 2016, and there is no change. However, for your refreshing your memory, so this order applies to all the companies except, so there are some exceptions which have been given. So these are one-person company, small companies, banking companies, insurance companies, and Section 8 companies. And some of the private companies, which are small private companies, and there is a threshold which has been given there. For those companies also, CARO will not be applicable. So which are those private companies? Primarily, those who do not have paid up capital and reserves 1 crore or above. So that means their paid up capital and reserve is less than 1 crore as on balance sheet date. Now this point is important. The next point is that they have taken borrowings of less than 1 crore from any banks or financial institutions at any point of time during the year. So their capital and reserve and surplus below 1 crore. Their borrowing from banking or any other institution is below 1 crore. And their revenue is less than 10 crore. All these conditions are fulfilled, only then you will not be applying CARO, you will not be reporting. So if you are doing a statutory audit, you say that, okay, this company's paid up capital was less than 1 crore. However, during the year, company had taken a loan which went above 1 crore, so 1 crore something. But at the balance sheet date, it is still less than 1 crore and revenue is less than 10 crore. Will it be applicable? Will you need to report under this order of the central government? Yes, because the second bullet point is getting hit. So their borrowing was more than 1 crore during the year at any point of time. So please remember that only if all the three conditions are met, then you are not required to attach or give your report on this new order. So basically, it will not be applied on consolidated financial statements except for clause 21 of paragraph 3. So that means wherever there are, there are qualifications of the component auditors or the subsidiaries auditors. Those have to be reported in the CARO. So basically, the guidance note, which is issued by the institute, that becomes a major source of guidance for all of you who are doing the statutory audit. So my strong recommendation is that please go through that guidance note. Even if the new one is not yet out, the previous version is also quite detailed. It gives you the interpretation, it gives you the guidance, it gives you that while doing the audit, what activities are required to be done. So in my deliberation also, I will be, talking on the same lines. First, we will read the CARO, the order, the point, the requirement of the law. Then we will see what are the, critical areas. And then what you are required to do if you are doing the statutory audit, and what kind of audit work papers, what kind of information you should be asking for. So the changes, highlight of the changes in CARO. So there are, significant changes, and these changes are very important. And as a result of these changes, the Schedule 3 also has undergone a change, and those reporting has to be done by the management also. Many of the points have to be included in the new Schedule 3 in the financial statement because of requirement of Schedule 3. So CARO 2020 is basically now you will need to report on 50 assertions, which are included in 21 clauses. Previously, there were only 16 clauses. Many changes and many new clauses which have been added. Previous clauses have been revised. So as a summary, there are 28 new reporting requirement, with requirements which are there, and these include the sub-clauses also. So in 16 cases, the reporting requirements have been modified. At some places, they have given the format of the table. Some places they have changed a little bit, but there are changes which are 16 changes with 16 sub-clauses or 16 requirements have undergone a change or a modification. 7 clauses, there are no changes or no modification, and 1 clause had been deleted from the previous CARO. So this is the summary of changes which have happened from CARO 2016 to CARO 2020. So let's go straight forward to the clause, the first one, which is on property, plant and equipment. So give me 1 second. So basically, the idea why we are studying it and why we are looking at these new statements are because whenever we are doing the audit, we will need to carry out our audit in such a manner that we are able to collect audit evidence. We are able to, demonstrate to the regulator that, we carried out our audit and we reached to the conclusion which is given in our reporting. So let us first read the 2 clauses which are 3.1a and 3.1b. They are related to property, plant and equipment and intangibles. So let us read carefully, and I will highlight the words which are supposed to be kept in mind, which are your focus areas. 3.1a, whether the company is maintaining proper records showing full particulars, including quantitative details and situation of property, plant and equipment. B, whether the company is maintaining proper records showing full particulars of intangible assets. So what is required is that you as auditor need to report or give a statement whether the company is maintaining proper records. So the keyword is proper records, showing full particulars, including quantitative details. And in case of intangible assets, full particulars of intangible assets. Clause 131B, whether these property, plant, and equipment have been physically verified by the management at reasonable intervals, whether any material discrepancies were noticed on such verification, and if so, whether the same have been properly dealt with in the books of accounts. So, who is going to do the physical verification? The management. And what you are supposed to do? You are supposed to report whether these PPE have been physically verified by the management, and you also have to see whether those physical verifications are at reasonable intervals. So, and whether there was discrepancies. So the analysis of this clause, when we look into this, so the first one, and that is very, very important for all of us, the terminology has been changed from fixed assets to property, plant, and equipment. And that is consistent with Ind AS. That is consistent along with all the other global standards. So you need to please remember this fact that now no more using the word fixed assets. What we are using is property, plant, and equipment in all the literature. So this particular clause also incorporates the detail of intangible assets. And also you need to, so there was a question whether you need to include investment property also. Yes, investment property and also the non-current assets held for sale, which is required to be reported. So according to Ind AS 105, so that will be included in this. So that means when you are looking at whether the management is maintaining proper records, you will need to see whether investment property is also included there and non-current assets also included there. Although there is no specific format, given in the CARO or elsewhere that what kind of records need to be maintained, but it is a little subjective. But it depends upon the mode of accounts keeping, whether the company is maintaining manual accounts or computerized, or the kind of complexity which is there, the kind of branches or their offices or operating locations, what kind of control systems they have. Then according to that, you will need to see whether the records are maintained properly or not. Where some places some auditors have reported that PPE register is not maintained by the company. So if it is like that, then it is a serious documentation and control lacuna. So you also will need to see whether that is having an impact on the true and fair view opinion of the financial statements. Because as auditors, you also need to draw, to carry out your audit procedures to see how what value have, they disclosed in the financial statements related to PPE and intangibles. Now we talk about the physical verification. Please remember, that the critical point is that who is responsible to do the physical verification? It is responsibility of the management. So then why do auditors go on 31st March to do? So many times the companies, invite the auditors to on 31st March or at the year end to see whether the physical verification is being done properly or not. So the auditor's role is to see whether the management is physically verifying, what is the process which the management is following, and this reasonable interval word is also, it depends on the circumstances of the case. So sometimes people ask a question whether is it necessary the management to physically verify all the assets annually? So is it necessary to do it every year end? So many companies, they do it every quarter end. Many companies, they do it after every month end. And many companies, they do it after 2 years. So it depends on case to case. So as auditors, you need to have your own professional judgment whether this frequency or this kind of time gap is sufficient or not. And then the discrepancy, in case the material, the discrepancy is material or not, then even then the auditor has to use his professional judgment. Of course, the materiality levels are defined according to the standards on auditing, and it is mutually agreed by the management and the auditors. It remains a subjective, so still you need to understand and you need to document. So the difference was this much, but our materiality level was this much, so it is below materiality level or higher than materiality level. Now, this clause, which is 3(1)(c), going to the next clause, is creating a lot of discussion. There is a slight modification. There is a table which has been given in CARO. And let us read the clause. Whether the title deeds of all the immovable properties, then there is a bracket. So bracket says other than the properties where the company is the lessee and the lease agreement are duly executed in favor of the lessee. So that bracket we ignore now. Whether the title deeds, and I'm reading it again, whether the title deeds of all the immovable properties disclosed in the financial statements are held in the name of company. And if not, then provide the details thereof in the format given below. Description of the property, gross carrying value, held in the name of who is, whose name is written on the title deed. And then the most difficult part, whether promoter or director or their relative or employee. So here you will need to apply your judgment. You need to carry out your audit procedures. And then you will need to, mention whatever is required to be mentioned in this particular clause. Then period held indicate the range where appropriate, and reason for not being held of the in the name of the company. In case there are any disputes or any restriction, you also mention there. So this clause is very critical, especially for smaller private companies or the family-owned companies. Let us do an analysis of this. So detail is to be given in the specific format which was not there earlier. And this clause also requires disclosures if any immovable property is held in the name of a promoter or a director or their relative or employees. So you need to understand who is the promoter, and then whether you will have information on their relatives or not. So you will need to specifically seek those questions, seek those that kind of information, that who are the promoters of this company, and then this title deed is in the name of this person, whether that person is a relative or not. And then you need to draw attention to the definitions of relative which have been given in the company's law and given in the accounting standards. Then it excludes the leased properties, but there are two views. Some of the experts, they say that leased properties are also the property, so that has to be included. So wherever there are discrepancy in these agreements, or it is not duly executed, it shall be prudent to include the act of such case. So my advice would be that you go, even if there is a reporting which is slightly extra reporting, you do that. so that tomorrow the question should not be asked that why have you not reported? It was required under the CARO. The peculiar situation, the practical situation which some of the auditors might face is that those property papers might be mortgaged with the bank, or some loan might have been taken. So you will not be, as a statutory auditor, you will not be in a position to physically see the title deeds. Now, the promoter or the directors or the management of the company may say that, okay, these title deeds are lying in the bank and we have taken a loan. Here are the photocopies. So whether you need to rely on those photocopies, or you need to carry out those extra procedures, extra audit procedures. In my opinion, the photocopies, even if it is being given by the management, it will be prudent that you take a confirmation from the respective institution. You tell the bank that either you want to see the title deeds, or they need to give you some kind of written confirmation that title deed is in the name of this person. Then, sometimes the management may come back and say that, okay, we have lost those title deeds. There was some accident or some fire or something. Then you need to really obtain the audit evidence of whatever you are going to say in your report. You need to have that kind of documentation. Then, in case they have not been transferred on account of some kind of dispute, then you have to mention that dispute in the remarks column. So this is very, it is very important to look into the details of requirement of this clause, and especially the private companies which are, the family-owned companies where the property was held in the name of the person who has started the company, and some kind of agreement was signed, MOU was signed, and the company is taking that property in their balance sheet as asset. So you need to report, and this will be a challenge in some cases. Then we go to the next clause, which is 3(1)(d), where the company has revalued its property, plant, and equipment, including right to use assets or intangible assets, if the company has revalued during the year. And if yes, then whether the revaluation is based on valuation by the registered valuer, that is the first part you will need to report. And also specify the amount of change. And the clause says if the change is 10% or more in the aggregate of the net carrying value of each class of property, PPE. So basically, when we analyze this particular clause, so we see that, the property. So one point is very clear that under the Companies Act, now there are registered valuers. So you need to have an understanding, whether those valuers who have done the valuation, they are, registered under Section 247 of the Act or not. And then you also need to consider which are requirements of AS 10 and Ind AS 16, which says that, if you are revaluing one single item, then the entire class of PPE to which that item belongs should be revalued. And the clause requires disclosure if, if the difference is 10% or more. So, when you read the guidance note, it gives you very clear guidance what kind of information you should be seeking from the client, what kind of documentation you should be preparing in order to reach, to your conclusion. Now, another clause which is a new entrant into requirement, 3(1)(e), whether any proceedings have been initiated. So you need to apply your audit procedures to see whether any proceedings have been initiated. Of course, you will take the management representation letter, but if management is not willing to disclose that to you, they will give you incorrect representation letter, and then you will need to apply your other audit procedures. So first, whether any proceedings have been initiated or are pending against the company for holding any Benami property under the Benami Transaction Prohibition Act 1988 and rules made therein. So, if so, whether the company has appropriately disclosed the details in the financial statements. So, your responsibility, the auditor's responsibility, is to see whether that disclosure is there in the financial statements or not. That's it. You don't have to go into detailing of that. You have to see whether the proceedings which are there or proceedings which have been initiated, whether those have been disclosed in the financial statements or not. So, the basically your requirement from the statutory auditor is that you need to ensure or you need to see whether the disclosure has been done by the management. So when you look at the guidance note, it gives you a guidance that generally the disclosures should include the nature of the property, the carrying value, the status of proceedings, and consequential impact on the financial statement. There may be a possibility that liabilities may increase, and also required to evaluate the liability is required to be disclosed as contingent, or you are required to make a provision. You will also, so the guidance note also tells you that you will need to keep in mind the standard on auditing 560, which talks about subsequent events. So that means, proper disclosure has to be done even if the some development has taken place after 31st March, but before your signing of the balance sheet. So that means subsequent events. So you need to see how significant is that development. So in case any, under this clause Benami Act, any proceedings have started, even if after 31st March, a disclosure has to be done because this is a significant event, and this is even if it is subsequent to the 31st March. So you need to report as on the date of audit report. So whether the physical verification of inventory has been conducted at reasonable interval by the management, and whether, so this clause we have already seen. So 32A, inventory. So you will also be reporting in terms of, whether the inventory physical verification has been done by the management or not. So physical verification of inventory is, like I mentioned in case of PPE, it is a responsibility of the management, but it is necessary that auditors satisfy themselves that the physical verification was conducted at reasonable interval, and that is how and that is why the audit team generally go to the location of the client or the plant to see whether the physical verification is being done properly. So what constitute appropriate is a matter of professional judgment, but the auditor may determine what kind of audit procedures are required. But whatever you do, my recommendation is that please document whatever you are doing. So your papers, work papers and documents should demonstrate that you were actually, you had satisfied about this clause. Now this new subclause, which is a matter of debate, discussion, and I think if one clause has to be discussed amongst the statutory auditor, this clause is the one which is going to have a very, very large impact on the reporting. In today's session, I think this is one clause which will which should be highlight of the session. Let us read this 3.2b. Whether during any point of time of the year, the company has been sanctioned. Please remember and highlight the word sanctioned. Working capital limits in excess of 5 crores. So what we are talking about is the sanctioned limit. I'm not saying how much has been utilized and what is the outstanding balance. So if the limit is sanctioned is 5 crore or above, in aggregate from banks or financial institutions on the basis of security of current assets, then whether the quarterly returns or the statements filed by the company with such banks or financial institutions are in agreement with the books of accounts of the company. If not, then give detail. So now this is a very, very, practically speaking, very difficult clause. What happens and what happened in the past, the bankers would provide facility to the borrower on the basis of provisional financial statements, and the borrower every month will send the stock statement to the bank. On the basis of those stock statements, the drawing power is calculated by the bank and facility is given. Now, when the auditors used to do their audit, they used to look at the performance of the company, the financial position of the company during the year. And at the year end, whatever amount has been shown as inventory or stock, or so it was supposed to be done to give a true and fair opinion of the performance and the financial position of the company. But now this CARO clause also requires the auditors to have a look at those statements which are being submitted by the borrower to the bank. And here comes your challenge. How will you ensure that those statements were matching with the books of accounts or not? Now, the working capital of the company, it generally indicates the liquidity levels and covers inventory, cash, payable, account receivable, and they should be in form of credit facilities, which may be fund-based or, so generally it is cash credit, bank overdraft, trade credit, working capital loans, discount of bills, factoring. So you need to, as if you're doing the statutory audit, you need to check the sanction limit and not the utilization. Number one, sanction limit. Utilization may be less, but sanction limit you have to see. And you also have to see the returns which have been submitted to the bank. Now, how will you know that the same statement has been submitted to the bank? Because many times they just hand it over to the bank, and you need to see the original acknowledgement. And then for those returns which have been relevance with the books of accounts need to be reported. Qualitative statements should be ignored. And you are not supposed to do audit of those returns which are submitted. Many times the bankers, they insist the borrower should go and take a stamp of the auditor on that stock statement. Be very careful. If you are stamping that, even if for the identification purpose, please remember that it is in your knowledge and a copy is there with you. So, and it is matching with the books of accounts or not, that you have to report in CARO. So even if they are submitting every month, but this clause requires you to match only the quarterly ones. So that's an interesting part. The company might be submitting monthly returns or monthly statements, but you are required to do your audit procedures only on the quarterly statements. And then you will need to apply your professional judgment, determine the materiality, relevance, discrepancy, and you need to report in that clause. But please remember, this is something which is really, it might pose a little bit of challenge if you miss out on this. Now, the third item which we wanted to have a discussion on today is on internal audit. Whether the company has internal audit system, there was which is commensurate with the size and nature of the business, and whether the reports of internal auditors were considered by the statutory auditors. So you need to see and consider the reports of internal auditors. So, one, you will see whether it is commensurate with the size and nature of the business. And two, you need to see the factors, like nature and scale of the operations, scope and periodicity, and competence of the internal auditor, examine their reports, and what kind of follow up was done. So basically, you will need to consider those internal audit reports. So now that is something which you need to do. So going to the next clause, I think next clause will be taken by our next speaker. But two slides, last slides, which I want to share with you is on the documentation. Whichever activity you are reporting on, whichever clause you are reporting on, your document should demonstrate that you have done the planning, you have done the supervision, and accountability and responsibility of the work done is on the people, specifically identified who reviewed the work, who carried out the work. It should be a record for your future audits. So basically, it should enable, in case somebody wants to do the quality control review, and in case you're doing audit which is covering on, which is covered under the scope of NAFRA, then you need to really be very detailed. You need to maintain a detailed document so that you will be able to demonstrate to the people who are doing inspections. So, in case you are not able to do key audit procedures, like for example, during the COVID, the movement was restricted. So, what alternate procedures you had carried out? You will need to have a clear documentation on that, on those procedures. So, what kind of document you should maintain? It depends on the size, complexity, the risk of material misstatement, kind of the audit procedures you performed, and significance of the audit evidence. Then what methodology you use, what tools you used. So many times you see that it was in a very large ground, or the large land where the stock was lying. So we used the drones. Whichever way you are using the tools, or what kind of methodology you are using, you need to have a documentation around that. So in case there was some exceptions, then you need to record that as well. So with this, I stop my presentation, and I will welcome in case you have any questions. Otherwise, we can ask Nilesh to take the second one. So in case Anil ji, any questions are there, we can take up those questions. So maybe Mr. Nilesh, you can start with the second session, and then we will take the questions. In case Mr.
Sure, Praveen ji, sure.
Sir, can you hear me, sir? Can you hear me, sir?
Yeah, now I can hear you. Yeah.
Yes, sir. There is some. I hope there is some technical glitch. That is why voice was not going. So thank you so much, sir, for wonderful and detailed deliberation. And now, sir, if you permit, can we take questions together at 1:30, sir?
No, I think the question related to this session, please take it there because I may have to attend another call.
Okay, sir. Certain questions are there. First question is, sir, relating to, sir, one member is asking limit for exclusion of private limited company from applicability of CARO is 1 crore, and the definition of small company prescribed new threshold share capital 2 crores and turnover is 20 crores. So, member is asking about your views on this contradiction.
So that's fine. If it is a small company, then it is exempted. And otherwise, those which are not there, so then, those threshold limits are supposed to be seen. Yeah.
Yes, sir. Sir, how to report drawing power from bank when every bank calculated DP by their own way. Also, it is not possible when only memorandum records or no records are maintained for stock. In most of the cases, creditors are underreported within the knowledge of banks.
So the auditors are not supposed to report on drawing power. That is not required from the CARO. What CARO is asking that whatever statement they are submitting to the banks or the financial institution, whether those statements are matching with the books of accounts or not. Simple. You don't have to go into detailing of how much DP the bank is calculating and what kind of drawing power you are giving, whether the bank is treating it as non-performing or performing, whichever category they are putting in. No, this CARO reporting is only on the fact there are certain statements which are submitted to the bank, whether information given in those statements are matching with the books of accounts or not. Restrict your activities to this as far as this reporting is concerned.
Yes. So another member is asking, can deposits from shareholders be renewed through a book entry? This was done to avoid repaying and receiving back the same amount on the same day through banking channel. So what are the reporting requirements regarding this under clause 3 subsection 5?
We'll come to that in the next section when we will discuss about the deposits and the.
Yes, sir. One question is relating to the in CARO, we need to report clause 2 only when working capital limits from bank are in excess of 5 crores. But in disclosure of other information, are we supposed to give information of differences, if any, the book balances of stock and debtors with submitted ones?
So when we are doing our audit procedures, we need to ensure that clause by clause reporting is being done, and we need to see what is expected from the auditors as requirement of that clause. So when you are looking at that particular clause, so what I would recommend, have a checklist, a detailed checklist of CARO, fill up in front of each clause, and then collect your audit evidence and do your audit procedures in order to meet the requirement, and then you reach to the opinion. So if you are supposed to look at the statements which have been submitted to the bank, whether the bank has sanctioned a loan which is above that. So if it is below that, then there is no requirement. If it is above that, then there is a requirement. So you need to actually very closely read the requirement of the law. And then, for your audit procedures and analysis, I would still recommend go to the guidance note. It is very comprehensive document which the institute has published. So that will give you a lot of guidance. And wherever there are confusions, the AASB has also in the process of creating a technical support, which will be there. So a lot of members have already registered. So they will be providing you little help in case you are getting stuck in any of the CARO clause.
Yes, sir. Thank you for your advice, sir. So one question is relating to the PPE. If physical verification of PPE is done by an external agency or maybe your CA firm, not by the management himself, whether it is complying the CARO 3IB?
So they are doing it on behalf of the management only. So it is perfectly fine if management has asked somebody to do that kind of activity on their behalf. So it is fine.
And asset verification regarding capex work in programs and substantial investments made in real estate at Aswan, which has not been capitalized.
Yeah, this is an accounting issue. Now, I'll tell you as auditor, you need to see what kind of accounting has been done, whether it was required to be capitalized and not been capitalized, whether it was not required to be capitalized. That call or that decision is taken by the management on the basis of what? How did they conclude that this is a work in progress, this is still not to be capitalized? And then you need to challenge and you need to question. And you need to document that this is what you have asked from the management, and this is the answer which they have given, and whether you are satisfied or not. If you are satisfied, then fine. If you are not satisfied, then what impact it will have on the financial statement, on the profitability, on the balance sheet? Is it below materiality level or it is significantly materiality? If it is below materiality level, you can then decide what is supposed to be done, how to inform to the audit committee, and whether to bring it to the notice of those charged with governance. And if it is significantly impacting your profitability and performance or the financial position, then what kind of modification is required in the audit report? So you need to actually decide what is coming out from there.
Fine, sir. Fine, sir. Sir, one more question. If the director gives a machine to a company temporarily without any payment and without any documentation, and it is not shown as an asset in the financial statement of the company, then is it necessary to report about back and how to report it?
So very practical issue, very practical question. I think it is it is more of when you are doing audit of a smaller and smaller company, there may be a situation that this kind of transaction might have taken place. You need to see whether how much is the materiality of that particular item. So if director is not taking any rent or not taking any money, then whether that entry should have been there in the books of accounts or not. That entry should have been there as a loan from director, or it should have been there as a benefits which are supposed to be given to the director, or the rent which is not given, whether there is an underreporting of expense, whether there is underreporting of the asset, whether this company actually owns the machinery or it still remains with the audit with the director. So as auditor, you will need to look into all the areas, all the dimensions, and then see whether your true and fair opinion is also getting affected or not. Before coming to CARO, you need to see whether the balance sheet is having that kind of challenge, and in case you need to modify that report also. If it's not there, then you have to see whether it is covered in PPE or not. If it is not covered in PPE, then it is a separate issue. But if it is covered, then you will have to report in your CARO as well.
Fine, sir. Sir, thank you so much, sir, for sparing your valuable time. So on behalf of AASP of ICI, once again, I extend my heartiest thanks for sparing your valuable time and acceding to our request on a very shorter notice. Thank you so much, sir. Thank you so much. Thank you so much, sir, for your words of wisdom. So moving on to the next three clauses relating to the non-cash transaction and CSR, etc. We are having with us CA Nilesh Kemka ji. So it is my proud privilege to share with you the brief profile of Nilesh Kemka ji. Nilesh ji has experience of over 9 years in audits and financial accounting advisory services. He is working with one of the big four firm and as a financial accounting and advisory team. Apart from his bachelor's degree, Nilesh is an associate member of Institute of Chartered Accountants of India. He is having extensive experience in accounting and auditing across different industries. He possesses strong technical knowledge and practical experience of IFRS and accounting standard. Financial reporting advisory services with respect to GAAP, convention, revenue recognition, accounting due diligence, advising on technical accounting change, accounting matters, implementation of IFRS and Ind AS. He was extensively involved for review of IFRS reports, IFRS financial statements, and technical memos for 300 plus audits client of EY Saudi on transition of the IFRS. He has been involved in resolving complex accounting issues with respect to financial instruments, revenue recognition, consolidation, lease accounting, business combination, etc. He has performed as a team lead on various gap convention and financial reporting engagements, including reviewing FCTR, intercompany reconciliation, deferred tax, interim interim reporting, liaising with the audits, coordination with the various teams. His key clients includes Oil and Natural Gas Limited, Oil and India Limited, Punjab National Bank, Mangalore Refinery, etc. He has been worked with a FP&A team for a client preparation of future projection next 5 years for the company and its new investment areas for the purpose of IPO filing. So without wasting much more time, still list is very vast. I request Nilesh ji to please deliberate on the rest of the three clauses for today. Over to Nilesh Kemka, please.
Thank you, sir, for the great opportunity. And I must say that was a wonderful session by Praveen, sir, for all the three clauses from the practical life scenario. I do have one doubt, but I call you separately. Will not involve the time of all the members. Let me share my screen and.
Yes, sir.
Anilji, is this screen visible?
Yes, sir. Yes, sir. Make it full screen, sir.
Yeah, I done.
Fine.
Yeah.
Fine.
So, companies auditors report order 2020. We will be covering three clauses in these next 40-45 minutes. Reporting on the CSR, resignation of statutory auditors, and non-cash transaction. Now, first two clauses, corporate social responsibility reporting and resignation of statutory auditor, are being introduced in CARO 2020 as the new clauses. Non-cash transaction is carried forward from the previous CARO 2016 without any modifications. Now, before starting, I want to just emphasize why CARO 2020. What is the objective or importance? We are saying CARO 2020 has so many clauses, so many reporting requirements, from 16 clauses or 16 assertions to 21 clauses or 51 assertions. But why? What was the need? So, if put in simple words, CARO 2020 brings more enhanced reporting disclosures. Now, these reporting disclosures provide more accurate insights about the business with the complete accuracy to its stakeholders. Now, stakeholders are keen in knowing the operational and financial aspect. All these clauses or all the new clauses which has been added in the CARO 2020, they provide enhanced disclosures, which in turn provides the shadow about the corporate failures well in advance. Right? If we see, there were many fraud instances reported while the corporates in India were reporting for their financial year ended March 19 results. Now, the fraud instances included like diversion of funds, misappropriation of inventories, siphoning of funds, right? So, among other reasons, this is one of the peculiar reasons why we are seeing so much change in the CARO or the CARO 2020. Then there's increased expectations or enhanced expectations from various regulators, be it ICAI, be it SEBI, be it RBI, NAFRA, SFIO, CBIC, and others. Plus, there is an increased pressure on regulators to demonstrate they are acting against the senior management or the guilty senior management. Right. Apart from these, there are various new clauses on evergreening of loans, going concern issue, where cash losses are there. This clause is reinstated from CARO 2003. Then we have corporate social responsibility, whistleblower, frauds, loans advanced to related parties, internal auditors, and the last minute auditor resignation, which is more important. We have seen in last 2 years, there are various auditors who have resigned. Instantly, maybe day or two before the AGM, or let's say when the companies were expected to announce their results. So, considering all these scenarios, MCA has updated the CARO 2020 to cater all these scenarios. Now, applicability and what are the clauses changes are very well deliberated by Praveen ji. So I'll not take much time over here. So let's engage in discussion on our three clauses. First one, which I wish to cover, is the corporate social responsibility reporting. The related clause in CARO 2020 is 320. Why CSR? Why the reporting requirement is introduced in CARO 2020? The major reason is Section 135 of the Companies Act 2013, which is applicable to certain class of companies which fulfill some criteria like the net worth 500 crores or more, revenue 1000 crore or more, net profit 5 crore or more during the preceding financial year. If any of the requirements of the Section 135 is applicable to any company, then that company is required to spend 2% of the average net profit of last preceding 3 years. So before CARO 2020, companies were reporting as a part of financial statement disclosures. So there were set disclosures, what was the amount required to be spent, what the company has spent, what was the nature of activities. Some of these changes have been incorporated in Schedule 3 as the amendments. Some of the disclosures were there from earlier years. So now we as an auditor are required to report on certain aspects for the ongoing projects and the projects which has ended or their time period has ended. If this clause was not there in CARO, then also we were checking all the requirements of Section 135, whether the company has spent the required amount, whether the company has created the provision if required, whether the company is incurring the expenditure on the activities which are laid down in Schedule 7 of the Companies Act, and all the things. We were reading board minutes, we were adhering to the CSR policy, we were checking any recommendation of CSR committee, right? But now, more importantly, the onus has been put on us by virtue of including these clauses in the CARO 2020. Earlier, we were only doing our audit procedure. Now we need to report on that also. So clause 320 has two sub-assertions. One is related to unspent amount with respect to other than non-going projects. The second assertion is unspent amount for ongoing projects. And these are new clauses. There is no modifications of the earlier clauses. So let's see one by one. So first clause or first assertion within clause 320 says auditors need to report whether in respect of the other than ongoing projects, the company has transferred unspent amount to a fund which is specified in Schedule 7 to the Companies Act within 6 months of the expiry of financial year. Now, this requirement is coming out of second proviso of Section 135, subsection 5. Here, first of all, as an auditor, we need to evaluate whether the Section 135 is applicable on the company or not, Because if the section 135 is not applicable on the company by virtue of the requirements of net worth, turnover, and net profit, then this clause will not be applicable. Once we evaluate and find this clause is applicable or this section is applicable to the company, then auditor is required to comment whether any unspent amount with respect to other than the ongoing project, the company has transferred that unspent amount in a fund which are specified under Schedule 7 of the Companies Act. And that amount has to be transferred within the timeline mentioned. That is 6 months in this case. Now, let's suppose we are closing the audit, let's say in July. Now, only 4 months have passed. How do we report on that? We need to discuss with the management the plan, whether management will be depositing within 6 months. We need to obtain as a part of our audit procedure the management representation letter and all. Right? Because if we are issuing audit report in July, the time is still available with the management. The 2 months are still available. So in that case, we need to apply our professional judgment. We need to apply other audit procedure to assess whether the amount will be deposited or not, considering the cash availability and all, the commitment of the company, right? Now, if we evaluate the section 135 of the Companies Act 2013 is applicable on the company, then we need to obtain the board minutes or board approval with respect to the CSR policy as recommended by CSR committee. So one step back, if the section 135 is applicable on the company, then the respective companies are required to have the CSR committee on the board. Now, this CSR committee will formulate or adopt CSR policy as per which the company need to incur expenditure, which it is required to expend as per the calculations mentioned in section 198 of the Companies Act. So as soon as we evaluate section 135 is applicable on the company, we as an auditor need to obtain the board approval where the CSR policy is recommended by CSR committee, agenda and minutes of the CSR committee to know what activities have been undertaken during the year, what is the budget allocated, what are the amounts required to be spent, what the amounts have been spent during the year. Now, section 198 details the formula for calculating the amount to be spent by the respective companies during the financial year. Section 198 says what items need to be included, what items need to be excluded from the calculations. So as an auditor, we need to review that workings, whether the amount calculated as per section 198 is correctly calculated or not. Then auditor is required to obtain management confirmations, whether the company is taking, whether all the CSR activities which the management or the company has undertaken during the year are as per the Schedule 7 of the Companies Act. Right? So we need to have the list of all the activities which as a part of CSR policy company has undertaken during the year. We need to have the management representation. Then we need to also check from the Schedule 7 whether all the activities which the company has undertaken during the year are listed down in Schedule 7 of the Act or not. Apart from this, we need to have one list where company has spent the amount and what the amount is being remaining unspent towards all the activities. Because primary requirement of this clause is to report on the unspent amount towards the projects which are not ongoing. So we need to have listing from the management regarding the unspent amount. Now, audit procedure to check the amount spent towards the CSR activities are, let's say, the supporting documents, maybe bills, invoices of vendors, bank statements, whether the amount which the management is saying they have spent during the year is actually spent or not. So we need to apply our audit procedure on that aspects also. Now, basis the audit procedure applied on the amount spent during the year, we need to corroborate our audit evidence to ensure whatever the amount and spent management is giving to us and what we have calculated based on audit procedure are same. So let's say management says we have 2 crores of amount which is remaining to be unspent towards the projects which are not ongoing as on the reporting date. Now we need to have or revise our audit procedure in such a way. So starting from what the amount was required to be spent based on the review of calculations of section 198, then subtracting what the amount company has actually spent based on our audit procedures towards amount spent, like reviewing the expenditure bills, reviewing the bank statements, and others. And then the amount which comes should tally with the unspent amount of 2 crores. Now, another task is to verify whether the unspent amount has been transferred to a fund as mentioned in Schedule 7 of the Act within 6 months from the expiry of financial year. There may be a case where companies committed as on the reporting date to incur expenditure towards any CSR activity. Then, as per Ind AS 37 or AS 29 as applicable, companies are required to recognize the provision to that extent. So this is again an audit procedure which we need to do as a part of reporting under this clause. Finally, after doing all our audit checks and audit procedures, we need to obtain or we may obtain a management representation letter to this effect from the management that company has complied with all the sections of CSR 135, 198, Schedule 7 and all, right? But obtaining the management representation will not relieve us from our duties as an auditor to check all these aspects, because ultimately the onus is on us to report under this clause. Now, clause B within subclause B within clause 20 on CSR reporting is towards unspent amount for the ongoing projects. This requirement is coming out of section 135 subsection 6. Section 135 subsection 6 requires the transfer of unspent amount to a special account which a company is required to open as per this section. The time limit is 30 days from the end of financial year. So this clause read as, this clause requires the auditor to comment whether the company has transferred any unspent amount in respect of any ongoing project. So previous subclause was about other than ongoing project, which was governed by proviso 2 of subsection 5 of section 135. This clause is on unspent amount for ongoing project governed by subsection 6 of 135 section. Here the amount need to be transferred to a special account. Now this special account has to be opened in a scheduled bank, and it will be called as unspent corporate social responsibility account. So any unspent amount has to be transferred to this special account by the company within a period of 30 days from the end of financial year. Now, again, as a part of our audit procedure, we need to obtain board approval of CSR policy, agenda and minutes of the CSR committee, working of section 198. So these are same as we have discussed in the previous clause. Again, the auditor is required to obtain confirmation from the management of its compliance with the Schedule 7, Section 135, Section 198, right? All these are same, our audit procedures for amount spent, right? We need to examine again the expenditure receipt, bank statement to know what amount has been spent during the year, what is remaining as unspent, and whether that amount is being reconciled to what the management is saying amount is unspent. Lastly, we need to also obtain the management representation letter for its compliance with Section 135, Section 198 for its working, Schedule 7 with respect to the list of CSR activities, and transfer of unspent amount to a separate fund or to a separate bank account which has to be opened in the scheduled bank by the company. So reporting on these two clauses require extensive audit procedures with respect to the CSR applicability, amount required to be spent, audit of amount actually spent on the relevant activities as per Schedule 7 of the Companies Act, and eventually reporting on the unspent amount, whether the same has been transferred to a fund or to a separate bank account as applicable based on ongoing project or other than ongoing project, and eventually obtaining the management representation letter for its compliance. So second clause for our discussion today is the resignation of statutory auditors. So this is again a new clause which has been added in CARO 2020 because of various instances of statutory auditors being resigning from the audits immediately before the AGMs or board meetings or audit committee meetings. So the requirements are, we as an auditor need to report whether there is any resignation of the statutory auditor during the year. That means if we are the new incoming auditors, then we need to report, yes, there was a resignation during the year by statutory auditors. There was a casual vacancy which has been filled by virtue of appointing us as the statutory auditors. Now, the important aspect is we need to also consider the issues, objections, or concerns, if any, raised by the outgoing auditors. If the auditor has issued any modified or adverse opinion in previous limited review or audit report, or they have stated any reason in their resignation letter to the management, or the outgoing auditor has raised any concern or objections in the audit committee or in any presentation of the audit committee, then we as an auditor need to consider all these issues or objections being raised by the outgoing auditors as part of this clause in our first reporting. One clarification here, if there is any change of auditor due to the mandatory requirement of rotations as per Companies Act 2013, that is not covered here because that change is required by Companies Act 2013. So this is out of the scope of this particular clause. So audit procedures or reporting considerations over here would be like whenever we are appointed as a new auditor of any company, so we are required to communicate with the outgoing auditors or the erstwhile auditor to know why there has been a change in the auditor, why the outgoing auditor has resigned, what were the reasons, what were the concerns, if they have raised in writing, so we may come to know from the forms which have been submitted to ROC, or the reasons, if any, has been stated in the resignation letter. But there could be instances where the reasons or concerns are not documented, and we may come to know from our formal communication with the outgoing auditors. This is important to safeguard the interest of the stakeholders, independence of the accountants, and most primarily is our own interest. Now, the new auditor is required or should comply with the provisions of ICAI Code of Ethics. Then there is an implementation guide on resignation from the audit of financial statement. In case of listed company, we need to ensure the company or we are in compliance with the SEBI circular dated 18 October 2019, wherein the information has to be submitted with the SEBI for the resignation of auditors, detailing the reasons. Now, incoming auditor need to obtain resignation letter, Form ADT3, which is submitted to ROC to ascertain the reasons for the resignation, to know the concerns, because primarily the onus is on us to report whether there were any issues or objections or concerns raised by the outgoing auditors, and we can only know these reasons from the resignation letter, from the form which are filed with the ROC, from the various presentations, if any, made to the audit committee, right? And again, then we need to exercise our professional judgment while we evaluate the various reasons of resignation. Now, we are also required to review or to refer the last audited report or review report to see if there are any modifications, if there are any adverse opinion, right? And lastly, after reviewing all these documents, all these forms and presentations, and applying our professional judgment, we need to also obtain a management representation letter stating these are only the concerns or objections being raised by the outgoing auditors, and there are no other reasons. No other reasons from the list which we have obtained, or the listing which we have prepared based on our interaction with the previous auditors, based on our reading of board minutes, based on our reading of last audited report, and the forms and the resignation letter. So again, this is very important clause, because ultimately, the onus is on us as the incoming auditor to report the concerns of the outgoing auditors as part of this CARO requirement. Third is non-cash transaction. There is no modification, or I would say this clause is same as that carried forward from CARO 2016 without any modification. So there are two parts to this clause. First is we as an auditor need to report whether the company has entered into any non-cash transaction with any director or any persons connected with him. Secondly, if there is any transaction being entered by the company, then we need to report whether the section 192 provisions have been complied with or not. So section 192 of the Companies Act 2013 deals with the restriction on non-cash transaction involving directors or any person connected with them. So there is a term persons connected with them. This is not defined in Companies Act 2013. However, there is a term any person in whom the directors are interested. I think relevant section is 185. So we can obtain or we can use guidance from there. Then we have the definition of relatives in section 2. We can have guidance from them for there to ascertain who could be the persons connected with them or person connected with directors. Because this particular term is not defined anywhere in the Companies Act 2013. Now, Section 192 prohibits the company in entering into the any arrangements where director or any person connected with them acquire any asset from the company or from its holding company or from its associate company for consideration other than cash. So, Section 192 prohibits any non-cash transactions by which director of the company or the holding company or the associate company or the subsidiary company acquires any asset or will acquire any asset for consideration other than cash, or if such type of arrangements are entered by company with director where company will acquire. So first point is where director is acquiring from the company. Second is where company is acquiring from the director or any person connected with them. Any asset where the consideration is other than cash. So that is a non-cash transaction. These are prohibited. However, if the company passes a resolution in the general meeting for its approval, then it can be entered. Where the director is of the holding company, then the holding company also need to pass the similar approval, a similar resolution in the general meeting for its approval. So if the approval is taken from the members in general meeting by passing a resolution, then company can enter into non-cash transaction as prohibited by Section 192. So reporting requirements are, if the company has entered into such transaction, then we need to see if these are in compliant with Section 192 or not. Section 192 says passing a resolution in the general meeting for approval of such type of transactions. So if the approval has been taken in the general meeting, then we can or the company can enter into such type of transactions. So one clarification here, if let's say the acquisition of the asset has taken place in, let's say, last year, and in the current year company is discharging its liability, then this is not the non-cash transaction because a liability has already been booked in the last year. Second is if any merger is happening due to court approved scheme and the companies are required to adhere to the court orders, then this clause will not be applicable in that cases. So the question is how we will come to know whether any non-cash transaction has happened or not. First, we need to apply our audit procedures. We need to review if there is any change in the PPE register. We need to see various minutes of the general meeting, board of directors meeting. We need to see form number 1 to assess the persons where director has interest. Then MBP 2 to review the register of loans and advances being made by the company. MBP 4, register of contract with the related party. Now all these MBP 1, 2 and 4 will give us an idea whether any transactions during the year has happened with any of the director or any of the persons where the director is interested, or let's say director is connected. Then if there is any change in the PPE register or there is any movement in the PPE schedule, then we can obtain the listing If there is a purchase, then from whom the assets have been purchased. If there is any disposal, then to whom the assets have been sold. And then we may come to know whether the transaction has happened with any director or any persons where the director has any connection or is related to anyone. Then the various report if available in the public domain. Second is we need to obtain the listing from the management or the management representation whether there are any non-cash transactions have happened during the year or not, right? And based on all these documents, based on the management representations and applying our professional judgment, we need to come at the consensus or at the conclusions whether there are any transactions or non-cash transactions happened during the year with the director or any connected persons. And if such transactions has happened, whether the company has taken prior approval in the general meeting or not. So this was all about these three clauses which we need to report as a part of our reporting considerations under CARO 2020. Now I'm happy to take the queries from the members. Anilji?
So can you hear me?
Yes, Anilji, I can hear you.
Sir, there are certain questions relating to CSR. This is CSR ongoing projects. Case of ongoing projects, also provision is required to be made. The company has already deposited in escrow account, and as and when payment is made in debited to profit and loss account.
Right, sir.
So please elaborate what are the ongoing projects and other than ongoing projects in respect of CSR activities.
So members, the ongoing project and other than ongoing project depends on the timelines, right? So eventually we are required to spend the amount within 3 years, right? So let's say if we are auditing, let's say March 2020 financials. So whatever amount as per the March 2020 we are required to spend, we have 3 years to spend. So after 3 years, that project will go on the non-ongoing project, because within 3 years we need to spend that amount. So for 3 years, this will be in ongoing projects. If we are building, let's say, any school or any religious structure, or let's say any immovable property, right? So after the completion of these 3 years, which is mentioned in section 135, the projects come within the category of other than ongoing.
Yes, sir. Sir, in CSR applies for 2021 because company met the criteria. Next year, 21-22, company is not meeting any threshold for applicability. Then will CSR be applicable for 21-22?
Yes, once it has been applicable, it is applicable.
Once it has been applicable, then it is applicable for every year.
Correct.
Okay, sir. And sir, reporting of unspent CSR amount is required for relevant financial year only, or unspent amount of previous year should also to be reported?
Yes, total unspent amount as on the date.
Total unspent, last year as well as this year.
Right.
Whether any disclosure is to be made in CARO, even if the amount to be spent is created as provisions as on 31st March and spent subsequently before the auditor signing of the financial statements.
So I missed that. So in case there is any unspent amount and that amount has not been deposited within the timelines specified in section 135 in, let's say, specified fund or the bank account, then we need to report in a table for which financial year the amount relates, what was the unspent amount, what was the due date to deposit that amount, and on which date the amount has been deposited. Now, coming on to this, if let's say the timeline is still available of 6 months. I took an example where we are signing the audit report, let's say on 31st July. So 2 months are still there if we count 6 months from 1st April, right? So in that case, we need to discuss with management whether management will be depositing the unspent amount within, let's say, August and September. And if management says yes, then we need to obtain the management representation letter. And based on that, either we may say the as on date, the amount is not deposited, but management is committed to deposit the unspent amount before 30th September. Because as on date, we don't have any evidence apart from the management representation letter.
Yes, sir. So company has transferred required amount under CSR activity to a trust for spending the amount for an agreed purpose. But the trust could not spend for the purpose taken the amount and return the amount back to the company before 31st March. How the auditor would deal in this case?
So in that case, that is the unspent amount. Because see, eventually the onus or the responsibility is the company's responsibility to spend on the CSR activities. Now, what happens? Many large corporates, they set up their own NGOs or trust or Section 8 companies to take up these CSR activities, and they transfer their respective required amount to be spent to these trust or NGO or Section 8 companies. And these trust or NGOs or Section 8 companies carry out these CSR activities on behalf of the companies. So this is the responsibility of the company to spend the required amount. If the amount is not spent by NGOs and they are returning that amount, then this will be if the timeline is still there, then company can spend. And if the timeline has ended, then this is the unspent amount which needs to be deposited as per Section 135.
So one question is relating to the definition of person. Person connected with directors shall also include in business activities. So can you elaborate the meaning of person here?
Yes. So, sir, as I mentioned, there is no term defined in the Companies Act, persons connected with the directors. However, Section 185 defines the term a person in whose director is interested. So we can take the guidance from there.
Okay. So real estate company given a flat in its real estate project to a director against his due remuneration, whether this is to be reported?
Sir, your voice was cracking. Can you please repeat again?
Sir, question is real estate company given a flat to its real estate project to its director against the due remuneration. That means in lieu of the remuneration, they have given the flat. So whether this is to be reported?
Again, this is a tricky question. I think this needs to be reported because in lieu of the salary, we are giving him the rented space or the space, right? So this is a non-cash transaction.
Non-cash. One question is relating to this again CSR. The company is making contribution to PM funds or to another Section 8 company, and there is a shortfall. So the auditor will report in para of clause 20, but what should be reported in para B of clause 20 relating to CSR if the company does not have any ongoing projects?
So if there are no ongoing project, then we as an auditor just need to state as on the reporting date, company does not have any ongoing projects.
And a provision is required for such, sir. A provision is required to be made for ongoing projects for the unspent amount.
For both, for ongoing as well as non-ongoing. If the company is committed to spend in future, where company has entered into any contract with, let's say, any party to construct, let's say, a building or a hospital. So in that case, as per Section 1, as per Ind AS 37 or AS 29, as applicable to the company, company is required to make provision for that particular amount.
Fine, sir. One last question, sir. Whether an immovable property acquired by director from company at cash consideration, but is inadequate consideration, whether it is to be reported in that clause?
That should be reported, not as part of this clause, but Here the amount which we are saying, it is not being taken at the fair value. Then the company is passing the benefit on to the director, which is not permitted, right? Or which is in contravention of the Companies Act. So this needs to be reported as a part of CARO, maybe in other matters or key audit matters paragraph as applicable, but not as part of this clause.
Sir, one question relating to the transfer to the trust. In case the company, I have already raised the question with you. The same question is, in case the company has transferred the funds to the trust and there is no intention to return, still the amount unspent by the trust will be considered as unspent amount in the hands of the company.
Right, sir. Right, sir. Because if we have given any amount to trust, then as an audit consideration or audit procedure, we need to obtain one certificate from that particular trust or NGO that they have spent the amount on the CSR activities or not. So if the trust is saying they have not spent the amount, then it will be counted as unspent amount, and company is liable to spend that amount in future.
Fine, sir. Thank you so much, sir, relating to this, giving the detailed discussion on various these three clauses and detailed answers on this CSR related clause. So on behalf of AASB of ICI, thank you so much for sparing your valuable time and sharing your expert advice on various these three clauses on CARO 2020. Thank you so much, sir. And this is for the information of the members. Then on 30th of this month, that is on Monday, coming Monday, we are going to organize this, our second part of this clause by clause discussion on CARO 2020, where we will cover investment, guarantee, security and loans and advances, default and repayments of loans and other borrowings, compliance of section 185 and 186, acceptance of deposits and related party transactions. That means in part 2, we will again cover 5 clauses. And in the third part, we will cover the rest of the 10 clauses. So I request everyone to please register for the next part of this CARO 2022 clause by clause discussion, which is going to be held on Monday, 30th at 3:30 p.m. Thank you so much. Thank you so much for joining. Thank you so much.